Hey everybody, Rocky and Alex here, and today we have a very special show, a topic that a lot of people love, called cost segregation. In another word, how to save money and pay less taxes, right? That's ultimately
Right.
a goal for a lot of people in real estate is how do I get more depreciations legally? Now, I do want to say everything that we talked about over here is mainly for educational purposes only, right? You still have to double check everything with whether it's your attorney, your CPA, and especially it's different by state. But I'll tell you in general what could happen, and then we could run with this information. What do you think about that?
Right. Exactly. And I'm glad that you mentioned that because one of the things that excite our viewers about investing in real estate is the idea that you can get income with little to no tax, right?
Right.
So, and one of the ways that you can do that is really via cost segregation. So, first of all, Alex, what is cost segregation?
Well, cost segregation, there's something called depreciation in real estate investing and cost segregation. So when you look at this, depreciation, when you buy investment property, you're able to depreciate everything except for the land, okay, that the building is on over 27 and a half years, right?
Mhm.
So what the
Right.
government is saying in general is when you buy this house or this apartment, it will only last 27 and a half years because it will be worth nothing after 27 and a half years, but not the land. So for example, easy numbers, $1 million. When you buy a property for $1 million and you are able to, maybe the land costs 100,000, right? So now that's 900,000. You depreciate it over 27.5 years. It is depreciating about $37,727 per year. Okay. But what is cost segregation? Cost segregation is taking that $900,000 and accelerating that process through a 5, 10, 15 year process. Some still has to be over 27, but most of it will go into the 5, 10, or 15 year bucket. And you can accelerate it to depreciate against the income from the income property and the investment itself. So it can depreciate over the monthly distributions. It can depreciate over any income when you sell the property if you hold it for a good amount of time. That's how ultimately cost segregation actually works, is it accelerates that process instead of 27 and a half years to something a lot faster. Now, you know what the really cool thing is? So
Yeah.
usually when people buy stocks, right, when the stock goes up in value and they're getting distribution or dividends, that dividends is taxed, right? You have to pay either capital gains tax or income tax on it as well. But with depreciation of the property, the cash flow that you're getting is now depreciated. So it counts as a depreciation, so you don't pay taxes on it. What is even cooler is if you are a real estate professional, and you have to look up the meaning of a real estate professional. Usually is something that you have to be actively involved in real estate. That accelerated depreciation goes towards depreciating your income as a real estate professional as well.
Mhm.
You see, and that's the cool thing about it.
Like when you're a licensed realtor, is
Like
that
a
right?
licensed realtor, or maybe you're a broker,
Mm-hmm.
right?
Mm-hmm.
Um, maybe you are you work on Airbnb, you know,
Hmm.
so that's one of the ways that you can do it. Yeah, it's really
Right.
really awesome that way. Hmm.
Yeah. Sounds like it's really an awesome idea, right?
Yes.
So, and I'm sure that for a lot of our viewers, they're like, "What?" right? So if I'm gonna invest in, if I'm an investor in a syndication deal, um, what does that look like in, a more practical manner?
So if you are an investor in a syndication, what happens is, for example, what we have seen, at least right now, when it's accelerated depreciation, where you get a certain bonus depreciation with that cost segregation, we are currently seeing whatever our investors are investing. In general, they're getting between 50 to 70% back on their depreciation in year one. Now, what that means is, say you invest $100,000, right? And now that 100,000 is, invested into a syndication. At least 50 to 70,000 will be used, could be used to depreciate against any earnings in year one. And this is in 2022.
Wow.
2021 and
Mm.
2022 is what we are seeing right now. So potentially, if you are a real estate professional, let's just say, right, what potentially could happen is you will depreciate that 50 to 70,000 if you invest 100,000 towards your own income, or also the money that you are making from the investment itself, like the cash flow.
You mentioned something about bonus depreciation, Alex. How does that work when it comes to, investing?
So that's what it is that bonus depreciation, instead of waiting 5 years or 15 years, they're able to accelerate that process and put a lot of it into year one. And that's how someone's able to depreciate a lot more. Now, the great thing about real estate is when we refinance, say you invested the 100,000 and then 2 to 5 years later, we refinance the money out, right? A lot of times what I have seen is that when the refinance happens, people get about 30 to 60% of their money that they initially invested out. Now, they still have the same equity in the deal, right? But because their money is refinanced out and it's considered a loan, you actually get that chunk of money. It's non-taxable. And that's one of the
Mm.
great things about refinance is that it's non-taxable. It's a non-taxable event because it's considered a
Mhm.
loan, not a sale of the property.
Right.
You see, but the property still is cash flowing, right? You're still getting the equity, you're still cash flowing, except you have way less money in the deal, but you don't lose
Mhm.
any equity in the deal. And then when we sell the property, and you get another chunk of money profit, right? That's why when we talk about a property upon sale could be 1.5, 1.9, 2.0, maybe even 2.5 multiplier, is that when the property is sold, all the money that you've gotten from cash flow and also the refinance and sale is equal to a multiplier of the amount of money that you invested. So a 2.0x multiplier means that by the time the property is sold, we're projecting that whatever money that you put in, let's say 400,000, for example, you'll get 200,000 back throughout that time
Wow.
period. And that's the projected, um, the outcome of it, you see.
Right. Wow. Wow, that's a lot.
Right.
And so, just correct me if I'm wrong, Alex. So basically, what cost segregation is that, you are given an opportunity to basically depreciate the property and get that money, that depreciation back, right?
Right.
So you mentioned that they can put it in 5-year buckets. So is there a way for you to get it at one time, at one go, let's say the whole 27 years, and get the
Not the whole
depreciation?
27.5. Some are still split up
Mm,
over time.
mm,
And, but they'll get like about 50 to 70% of it in year one.
wow. And that's something that you can again invest,
Mm-hmm.
right?
Absolutely.
Okay. All right. Okay. So just one final question, Alex, I guess. So just in case if I decide to join, right, Zephyr Equity Group, is this going to be taken care of by the company, or do I have to do this manually for cost
No,
segregation?
you get a K1 at the end of every year from us, and you just give that to your CPA. So it's nothing that you have to do on your own. It's something that's already done for you. And as an investor, you get the benefits of all of that. It's pretty cool.
How cool is that?
Yeah. Yeah. Everything's done for you.
Oh,
Hmm.
yep. All right. Well, thank you very much, Alex, for your time, and I hope you enjoy the rest of the day.
Thank you so much, Rocky. Bye now.
All right. Bye bye.